All-time highs in S&P and the Nasdaq. Bitcoin reaches new all-time highs of 118, and the big beautiful bill passes, with the Fed hinting at 2 rate cuts in 2025. A great time for traders and probably a bad time for everyone else. All that and more on today's After Hours. Welcome to After Hours at TradersPost for Friday, July 11th, 2025. I'm one of your hosts, Tom Hartman, joined tonight, as ever, by Peter, big, beautiful Bill Hartman, to break down the madness of markets over the last week. And what a week it's been. Peter, all-time highs for the S&P, all-time highs for the Nasdaq, all-time highs for Bitcoin. Breakout in Russell. We have the dollar falling. We have gold. Looks like it might be breaking out again. We have altcoin season might have started all of a sudden. Guys, with all the problems in the world, it would seem counterintuitive that such good things could be happening for the markets. But if that's what you think, you ain't a trader. Isn't that right, Peter? Isn't that right that the stock market and the financial markets, especially where liquidity is concerned, is inversely correlated with bad news?
I found that out this week to my surprise.
That's right. Peter, if people have not been watching,
I'm really excited because Grok 4. I'm sorry. I thought you asked me how I was doing. No, go ahead.
No, Peter, people aren't here for this. People are here for the trade. Well, consider this, right? We've been talking about the importance of global dollar liquidity for 9 months now. It's very important. And I hope these all-time highs, I hope if you weren't thinking about it and you were thinking about narrative, that these all-time highs has really like stuck in your head of, hey, wait a minute, how can we be at all-time highs? The Fed hasn't cut rates yet. Bad news happening. Immigration crisis, war crisis. Why is it all-time highs? Remember COVID. Remember the global financial crisis. The bad news is met by liquidity. And if global liquidity goes up, assets that are highly correlated with global liquidity, namely equities, especially tech and Bitcoin, go up as well. But Peter, I want people to know this.
Yeah, but Jerry didn't cut rates. I call him Jerry.
It's so funny. It's so funny. Peter, if I were to ask you, so you know what the mandate is? I'm going to test you. Guys, if you're in chat, you know this, just let me know. What are the 2 things the Fed is supposed to do?
Low unemployment.
Correct.
And I forget the second one. Which one? What is it?
Stable prices.
Stable prices. I was just about to say stable prices.
Stable prices. Exactly. Yeah. Low unemployment and stable prices. In their mandate, does it say, but if this person is elected or this party is elected, then you gotta have to pause on those 2 mandates. Like you don't want to seem like too political. Is that what it says?
No, it doesn't. I don't think so.
Exactly. They have to do whatever they need to do in order to supply liquidity to the markets, because that's how you make stable prices. Unemployment, it's neither here nor there. I don't know that they care about employment so much as stable prices, especially in the bond market. That's important. Why? Because the Fed is in the job of selling bonds. United States is a bond sale. The thing that America exports is dollars and consequently bonds. Why? Because a dollar is just a bond of infinite maturity with 0 interest rates. Hope I didn't blow your brain there, Peter, with that for a second. Stop my line.
I've heard you.
Yeah, learned this from Stephen Van Meter. Very good explanation for it. Dollars and bonds are basically the same thing. Bonds are far more liquid, ironically. So the Fed has to sell bonds. Why? Because they have to finance the debt from the government. So they have to keep it going. So if liquidity isn't engineered, if they can't create that liquidity, if the liquidity is lacking, what happens to the government? They can't spend, they have to shrink. That's not going to happen.
But Doge, Tom. Doge was supposed to cut.
Yeah. Well, how's Elon and Donald Trump? How's their bromance going? Not so well, right? Elon wants to start the American Party. All right. That just tells you where things are going, moving away from fiscal prudence, which is
I don't think.
generally why
Generally,
it's
what?
generally why the Republicans are put into office, in order to rein back spending, bring back conservatism, bring back I don't know, saneness
Not for
in
the past 10 years.
spending. Yeah, exactly. I mean, that's why they're voted in, not what they do, not
I
what
don't
they
even
do at
think they
all.
talk about that anymore. They rarely talk about spending anymore.
No, Donald Trump and the acolytes, the MAGA movement was all about ending the wars, the deporting immigrants, make America great again, focus on production locally, grow GDP to combat the debt. Whole thing. It was all about this sort of like conservatism.
Yeah, but they weren't talking about smaller government like they used to. They used to talk about smaller government. Bush.
No, Peter. Vivek Ramaswamy was talking about cutting departments, whole departments, or cutting
Who?
staff.
Who?
If you have an odd number on your social insurance number, you're
Yeah, but it
fired
wasn't.
even when you're still there.
It wasn't like a main focus like it used to be. It really
No,
wasn't
I
a main
understand.
focus like it used
It's
to
not
be.
like back in the Ron Paul days, but the idea was that there's supposed to be a focus on productivity within the United States, make America great again, America first, whatever you want to call it. Right? There was supposed to be some semblance of where they become spending. I mean, Doge, the whole thing with Doge, the government efficiency. We're going to cut $2 trillion from the deficit. The whole thing. It was all about smaller, limited government. All the things. You know the words. It was all about that, right? So there was that sort of idea. That, in case you're not aware and you thought it was still going to be the case, is not happening. Big, beautiful bill. Let's talk about it, because we're talking about how the Fed's not cutting rates. So why is the market acting as if it is? Big, beautiful bill. Spending galore, hundreds of billions of dollars spent in all kinds of different ways, and that money needs to come from somewhere. Where does it come from?
Inflation.
No, bonds. Well, inflation. I mean, not technically inflation. It's more debasement of currency, but bonds. Right? They got to sell bonds. That means we got to get the interest rate down. We got to get that interest rate down before those bonds need to be purchased. They don't want to buy bonds at 5%.
You're saying they will be cutting? What's the forecast? Like,
first of all,
I heard
guaranteed they're going to be cutting. There's no way they're not cutting rates. Okay, I mean, you can take that to the bank. Not financial advice, do your own research, but they're cutting rates.
Why is it then that there was all this talk about trying to get Jerome Powell to cut rates? He's too slow, when all they had to do was jack up the spending and force him to cut rates?
Well, because if they cut rates, then the signal is sent sooner. So what, I don't know, I assume Scott Bessent knows this, Treasury Secretary. I don't know about Ludnick. I don't know about Trump. I don't know, the people making decisions. But the Fed, their main power isn't in cutting interest rates. It's in forward guidance. Have you heard this term?
Yes.
What they want to do is what's called jawbone the markets into front running their decisions, because they want the markets to act as if liquidity is increasing, so that the market participants participate and thus add liquidity. So they do things to signal to the market, one, that they're going to reduce the downside, and two, especially for bigger players, that they'll be able to refinance at lower interest rates. So borrow now, because when you refinance, you'll be able to get a lower interest rate. That's the whole part of the whole game here, right? That's the lowering of the volatility. Because if people are worried that they don't know what interest rates will be in the future or what they'll have to pay and whether the markets will be supported, well, then they don't participate as much. They pull back their capital, and then you have volatility, you have lower liquidity, and this thing feeds on itself until you get a deflationary spiral. But the Fed couldn't say that they're going to cut interest rates. But their dot plot, if I'm not mistaken, their dot plot from the FOMC statement was it last month? Was saying, June 17th, June 18th, the FOMC announced that the federal funds rate would remain at 4.25%.
Do I share your screen? Sorry.
No, to 4.5%. But the dot plot, a chart reflecting individual FOMC members' rate expectations, indicated a median projection of 225 basis point cuts in 2025, likely starting in September and possibly followed by another in December, lowering the rate to 3.75 to 4%. This was detailed in the SEP release alongside the June meeting minutes on July 10th, 2025. That means Jerome Powell says we're pausing, but the dot plot, the expectations are saying, hey, but we're probably going to cut twice this year. So forward guidance, which means you can act now as if they cut those two interest rate cuts.
What would be the difference if they just cut it? When people just then immediately start acting with more confidence?
Well, the idea is that they would be like, okay, well, the Fed is being partisan, political partisanship, and that would cause problems. And then also, if they cut without any like crisis or anything like that, it makes people blame the Fed if there's any problems down the line. They go, you're cutting to make the stock market go up higher, and you're exacerbating problems, and you're increasing the difference between the rich and the poor, this whole thing. Mm-hmm. So they want to avoid all that.
But
so what they do is they say, we're pausing, right, and they go, but we're probably going to be cutting later this year.
Yeah, but once they cut later this year, then they'll fall into that trap.
But they'll cut first, if the effect of them going to cut happens now, as if they did cut, then it doesn't matter if they don't cut later on. Did I tell you stock market's at all-time high?
They might not cut, is what you're saying?
It doesn't matter. If the people are behaving in that way, what does it matter if they cut?
Well, I'm addressing the fact that they would be blaming the Fed. So how does the Fed avoid blame? Even the forward guidance is associated with the Fed.
No, that's the brilliance of the forward guidance.
Oh.
The forward guidance is, well, we didn't say that. You just thought that. So
yeah, but that's like, why are you hitting yourself? And you're like, I'm not hitting myself.
No, Peter. The regular population, the regular folks, the congressmen who don't know a Krugerrand from a dollar bill, they're not listening to forward guidance. Uh-huh. They're not listening to forward guidance.
Okay.
They're not considering that. I wonder what it means, what the dot plot means, and how that historically matches with the interest rate. They're not thinking that. You think they have a Bloomberg machines? They don't even know Bloomberg has two O's in the word. They have no idea. Have you heard these hearings when they talk to the Fed and pull?
Somebody there must know. The committees.
Yes, but they're a minority. The Ron Pauls of the people of the world know, but so what? Ron Paul wanted to audit the Fed for 20 years, and that never happened. What difference does that make?
I get it. So they're not going to blame the Fed. So the Fed does a sneaky, and makes people think, oh, we might, and then they get the benefit without actually having to pull the trigger. Or if they do pull the trigger, at least they won't get the blame.
The greatest trick the devil ever played is making you think that they're going to cut interest rates when they haven't.
I don't think that's how that quote goes.
Pretty sure I'm paraphrasing it. It's the spirit of the thing. Okay, so what does that mean? If you had any doubt, so Mike and I were talking about weeks ago, liquidity is up and to the right. And it looks like it's going up and to the right, and it's continuing until basically September, October of this year. We'll see if it continues, but so far that's what it's saying. So all-time highs was always going to come. How much all-time highs, we don't know, right? You could peak a little bit, come down, go up, peak a little bit, come down, and go up. We could still have massive volatility where we go down 30%, rise up to all-time highs, fall 50%, rise up to all-time highs, fall 20%, rise up to all-time highs.
That's where the money's made.
Painful, but yeah, no kidding. But we're seeing the all-time highs, Bitcoin up, dollar falling, gold sideways, right? This is all euphoria stuff, right? This is all stuff that happens at tops. We're topping right now, and who knows how long this process might be. We might explode to the top, but that's where we are right now. And what's important, one, is that you know that it was always going to be the case. If you didn't think about this before, if you didn't realize this before, just know now, Tom and Mike were right. Okay, Tom and Mike were right. Global liquidity up, stock market up, Bitcoin up. I didn't believe it. Bitcoin all-time highs, Nasdaq all-time highs, S&P all-time highs. Okay, what's coming next? The expectation coming next is that eventually this ends, right? These euphoria phases end, but we're just now starting with the euphoria, just now starting with it. So you have stuff like, okay, so before we move there, I just want to actually point out something from Darius Dale, who's a fantastic analyst from 42 Macro, who makes I think a very salient point at the beginning of a recent video that he put out on Twitter that I think it behooves everyone to pay attention to. And that's the idea that you can't be wrapped up in the political aspect of this whole thing. Like, you can't place your bets favoring one political side or other. You have to face what's actually happening. You have to play the game as it actually is, and not bet, well, things are going bad, I think things will fall, and then bet that way. So let's go ahead and play Darius Dale here. We'll just play a couple of minutes of it because I think it's super relevant.
Before I get into this presentation, I want to remind everybody I'm wearing my purple tie, and the reason I'm wearing my purple tie is to remind every one of you that I'm a data-driven centrist. I'm not a Republican. I'm not a Democrat. I don't vote Republican. I don't vote Democrat. I'm a thoughtful, dispassionate, data-driven investor. I don't believe that you can be a great investor if you lean too far to the left or too far to the right politically. That's just my own personal belief, and this is why, in our opinion, we continue to, our results continue to reflect the way that our results look the way they do in your portfolios, because I'm a purple tie investor as opposed to a red tie or a blue tie investor. So hope you guys appreciate that. So if you hear anything today that, rubs you the wrong way because you're a Republican, or rubs you the wrong way because you're a Democrat, I don't care, quite frankly, but just be aware that it's not coming from a politicized place. So just be aware of that. But obviously you got to talk politics, because in a fiscal dominance regime, if you're not talking politics and the pivot to paradigm B, or the pivot from paradigm A to paradigm B to paradigm C, if you're not talking politics, you're missing 90% of what matters to financial markets this year. So you can bury your head in the sand if you want to, but we're not going to bury our heads in the sand. We're going to run the ball right up the middle and score a touchdown, just like my buddy.
Amen, brother. Amen. All right. So just to hear that to begin with, before we jump to the rest of the video, it doesn't matter. Peter, sometimes I feel heartless saying this. The stock market is at all-time highs.
Mm-hmm.
You could have made money on that way up. Okay? So it doesn't matter how outraged you are by whatever is happening. That doesn't matter to traders. What matters is, like, why are you here? You're trading, you're investing in order to make money, in order to safeguard yourself in the future. Yourself, your friends, your family, and all that sort of thing. So you got to understand what's going on. This is why it's important for traders to trade what's happening. And that's what I find is important about shows like After Hours, where you're paying attention to what is, and then finding the trades accordingly. Make your money and then make the change.
Evan,
so
Trader says,
yeah, go ahead.
I'm a purple guy myself. Are you a purple trader, Tom?
Absolutely. I mean, I used to not be. And then you lose enough money. Let me say that again. You lose enough money and your tie gets purple real quick. So, for example, I don't short equities. Why? Because it's like shorting America and shorting an empire. I mean, that's a terrible idea. You have all these market participants, the federal government, the central banks, the monetary and fiscal policy. You have sovereign funds, you have pension funds, hedge funds, all these people, all these elites, all these monies. They have every incentive in the world to make sure that stock market keeps going up, and you're going to bet against it in July, hoping for what? Best case scenario, stock market goes down to 100% and you double your money. What? Why bet for that?
So people are doing that because they hate Trump and the policies, and they think, of course, it's going to be a disaster. Things are going to go down. It's like, is that what's happening?
Correct. People thought that Donald Trump was going to come in and do and do all the things he said he was going to do. I'm watching content now, and people are like, I can't believe he's doing the same thing that Obama, that Biden, that Bush did, that Clinton did, that they're going all the way back to Reagan, Nixon, and all that. Like, I can't believe he's doing all that. Why would the president not do that? It doesn't make any sense to me.
Even Elon was like,
those other people were doing it. Like, what did you? He's got to keep the wheels spinning. You saw what happened with the tariffs. Tariffs thing came out, stock market dropped whatever 20% or whatever the hell it was. It dropped, and they're like, "Well, we can't have that." Phone ringing off the hook. I just lost this. I just lost that. I'd cave if the stock market dropped 2%.
This is why I thought the Elon Musk Trump feud was pretty funny. Elon's like, "What the F?" And I'm like,
right.
Have you not been paying attention? How can you be so smart and not spend? That's what's going to happen.
That's what's going to happen. That's right.
And the people don't want it to go, as far as I understand, the people don't want the spending to stop. I mean, they might say they want it to stop.
They might say they
actually want it to stop. So, I mean, or whatever he's creating in order to get the budget under control. We got to innovate our way out of this, okay? We got to AI ourselves out of this mess. It ain't going to happen because people like austerity and start cutting the pork.
Actually, it's funny that you're saying that. Darius has something to say on that, where he sort of pushed back on this idea that you can spend your way into productivity. So let's hear what he has to say. I'm going to jump around a little bit. The video is a little bit longer. Go to Darius Dale's. Actually, I'll post this inside of the comments. You want to go take a look at the full video and obviously sign up to his service in order to get way more from him. But let's get a taste here.
Marshawn Lynch. So get into it. To have conviction of where the economy and asset markets are headed in Paris and B, because the people in the red zones have figured something out, and it's telling you that they don't like crippling income and wealth inequality. They don't like 40-year highs in inflation, and they don't like being crowded out to a historic degree. And so they're going to vote for something different. Anything different. Could be a felon. Who cares? Just as long as it's different. And then finally, there is abundant evidence of Republican tax cuts catalyzing durable positive shocks.
Okay, so this chart, he goes over all the Republican tax cuts, which is like, what is it, $4.5 trillion in tax cuts in this big, beautiful bill. I think the biggest tax cuts that's ever been. And he shows here how 1981, 1986, 2001, 2003, 2017, all the cuts were followed by even more debt and a even more widening gap between the rich and the poor, the haves and the have-nots. Let's jump a little bit further ahead, because that's basically his point. He goes, it happens all the time. Federal budget increases, the deficit increases, and the income disparity also increases. All right.
As much as we would prefer Steve Moran's lullabies to be true, the thought of levering up to grow our way out of our fiscal mess seems preposterous to every credible source outside of the White House. So the White House Council of Economic Advisors released a paper a couple weeks ago. Hilarious. It was actually last week. They're hilarious assumptions in that paper. Don't even waste your time reading it. No offense to Steve Moran, who is brilliant. I have a tremendous amount of respect for Steve Moran, one of the smartest people in the world. But I think he's getting paid to say some things, and that is what it is. But they think the projected debt to GDP ratio in 2034 is going to be 94%. The CBO thinks it's going to be 124%. Committee for Responsible Federal Budget thinks it's going to be 127%. Penn Wharton budget model, it's going to be 125%. Our friends over at Yale Budget Lab.
All right, so these are all entities that are projecting that the money spent fiscally and monetarily will generate larger GDP, more productivity within society. That's the idea. Mm-hmm. So the question you have to have in your head is, well, do they have any incentive to say the opposite? Why would they ever say the opposite to that? All right.
It's going to be 125%. So right now it's 117%. The White House Council of Economic Advisors thinks it's going to go down 294%. All the rest of the other smart people in the world think it's going to go up to a mean of 119%, which includes their ridiculously low forecast, and a median of 125%. So everyone thinks it's going to add about roughly, let's call it on a median basis, 800 basis points to the national debt to GDP ratio. I don't know whose side, in my opinion, I think you'd have to be viewing the world through some very red colored glasses to.
Oh, that's my mistake. It's just the White House that is estimating that we grow out of it because of the leverage. My mistake.
To believe we're going to lever up and grow ourselves out of a debt problem. I mean, that sounds like that's crackhead math, folks. And trust me, I grew up with crackheads. I know what crackhead math is like, and this is it. In fairness to the Trump 2.0 administration, tariffs are likely to remain a powerful force for offsetting the cost of the one big ugly bill. So I got to give them credit, and they're not.
Okay. So then he goes on to talk about how the tariffs could do something to offset the cost of the bill. But what matters here is this idea that 4.5 trillion in tax cuts, 3.3 trillion in additional federal deficit cuts over the next 10 years. What does that mean? Liquidity is coming. They are going to be pumping. And this is what's happening on the fiscal side, the government side. On the monetary side, they're greasing the wheels behind the scenes because we're seeing the dollar fall. The dollar only falls like that with an increase in liquidity through central banks and stuff like that. As far as I know. So this is pretty interesting. Liquidity is there. You can bet on liquidity, which means that it's bad for the regular consumer. Let's just take a breath. As traders, we're taking money from somewhere, and sometimes that money is coming from the economy, the country. I don't know what else to tell you. They're debasing the currency. Like this is what happens. It's not necessarily inflationary in the way that you might be thinking about it, Peter. It's debasement of the currency. So or rather think of it as inflation, but in assets, either tangible or intangible assets. So stock market up, real estate up, bad for people who are not exposed, which means being exposed to the markets is extremely important in order to offset the debasement of the currency, which is definitely going to happen, is happening now, and will never stop.
Aren't most people in America exposed to the markets through their 401ks and things like that?
Not most people. It's class-based. And what is it? 70%, 80% of the stocks are held by the top 15%, something like that. I don't know the exact number, but some crazy amount. So mostly that. And then generationally, it is the boomers and some of the Gen Xers who own the assets, the tangible assets. And so they could buy a home at $150,000 that today is worth $3 million, but you and I can't go buy a $3 million home because of the divergence. Thanks, central banks.
You did it.
Love it. You did it. Stable
what's
prices,
the trade?
low unemployment.
What's the trade?
Okay, so the trade up until now was long everything. Well, long high beta, long Bitcoin, long S&P, long NASDAQ. Now, what can happen here, and we talked about this, I think, last week or the week before, Kim Carson bring this up, that what happens at these levels is that people will start selling calls. So they'll start selling calls in order to monetize the rise of the stock market. So they go, oh, the stock market's not going to go up any more than 5% or 10% over the next 90 days. Let me sell calls, which is an option to you're betting against the idea that the stock market will rise much more than that. And so you can have this environment where the market gets pinned near all-time highs. If we take a quick look at the NASDAQ, I'll show you what I'm talking about.
Yeah, let's get a chart up on the screen. Love these charts.
So let's say we take a look at, let's just take a look at SPX. All right, so you end up in these top-end patterns. Let's go with for example, over here. You have these top-end patterns, where so this is all-time high. So we had a drop in 2019 from Volmageddon, and then you have these all-time highs that happen, and then people are selling calls above here. The stock market breaks into there, and then there's a bunch of covering that happens because people were betting for the stock market not to happen over there. So you have shorts that get shorts that get squeezed out. You have people who bought calls that who sold calls, uncovered calls who get squeezed out. You get up to a major thing, then a crisis happens. This sort of thing happens again and again. Happens over here in the 2017. I think that was the last Trump win. Over here again, you have this top-in pattern, right? So all these little, most of these peaks are all-time highs or near all-time highs, right? That are happening. Then you have the crash that happens. So you can get pinned. The market can get pinned in these areas at all-time highs and not go like crazy high from there. This is global financial crisis, which was a little bit more exuberant. And this is the .com, where you have this sort of pattern. Now, how long it can go for depends on how much liquidity they're able to funnel into the markets and what the catalyst is that brings it down. Is it a war? Is it a plague? Is it a cyber attack, or whatever it is? So we don't know. So the trade for right now would be it's hard pressed to tell anybody to short. I think shorting is terrible idea unless you have some sort of edge, some sort of expertise. You've been doing this for a while. You don't start buying puts now every month until the market goes down. That's sort of like silly. Way better just to hold your money on the sideline, wait till the market goes down, and then buy, because you know it's going to be a V bottom from the bottom. But because of the liquidity, so the options market can sort of pin equities market, because the indices, S&P, NASDAQ, what have you, are used as hedging tools, right? So if you're long some stock, like for single name stocks, you would probably hedge yourself in the stock market. So what happens is that you have these prices, you have these zones where the price gets pinned, where all the market makers, in order to not have to pay out a bunch in puts or calls that get monetized, they sell when the market gets too high, they buy when the market gets too low, in order to keep the price of the stock market in a certain level, and that way it gets pinned at that level. The options expire out, they have to renew the options next month, and they were able to rake in the cash that way. But that same sort of effect doesn't necessarily happen in Bitcoin, because it's not such a sophisticated market that has all those sort of derivatives. And so what happens is that you have the Bitcoin market that can just freaking launch. You can just launch up. And if we toss on Mike's liquidity indicator here, what was it? Do I have it? One second here.
I think it's called Mike's indicator.
Okay, if we take a look at Bitcoin, where are you? Oh, hey, did I delete it? No, there it is. So you have the liquidity chart that we follow, and it is going up and to the right, and it starts to peak out here in September 2025. So my likelihood right now, depending on seeing how the chart is right now, is that we're going to continue to rise. Bitcoin is going to continue to rise pretty dramatically until around mid-September. So September, October makes sense. That's usually when there's going to be any type of weakness within the markets. It happens 4 times during the year, especially during September, October, especially during March, April. February, March, April. And so I would expect Bitcoin to go up from there. So long Bitcoin, long assets, that can happen all the way up until that point. Do I say buy Bitcoin now? Hey, I said buy Bitcoin was at 74. I don't know what to tell you. But yeah, I think Bitcoin still goes up. Now, the thing I find interesting, in fact, I might want to end on this point, is that we've been waiting for altcoin season to pick up. You know what I mean? Altcoin season, where the Ethereums, the Solanas, the Doges, the Cardanos of the world, where they would start picking up. Well, my dears, we're starting to see that. Actually, let me pull up. We're starting to see that. This is Cardano today, right? Beautiful pattern. So we have here this pattern where we have this pull down, pull up, pull down, pull up. And so the idea that Cardano might rocket from over here, to me, is like basically a guarantee. Basically.
Not financial. Do your own research.
Do your own research, not financial advice. Everything I'm saying, do the opposite of, and you'll probably have better luck. But this to me is a beautiful breakout or potential breakout. We take a look at Solana, still in accumulation mode. We'll see what happens there. Let's move on to a more serious token. Doge. Doge, we have this pattern. Same thing. Pull down to trend. Rise up, pull down the trend, rise up, pull down the trend, rise up. So do we see Doge rising 400% over before the end of the year? Yes. Maybe. Maybe. But you tell me, you look at that chart and you tell me that chart doesn't look like it wants to rise, baby. And of course, XRP, which XRP is special, right? Because there's a connection to Tether, the USDT, and then there's a whole thing that's going on in stable coins in the market where I've mentioned this elsewhere, but the stablecoin market is one of the major buyers of US treasuries. What did I say the Fed was in the market of? They're there to sell bonds.
Sell bonds.
Yeah. By buying bonds, but selling bonds to the primary dealers and to other people. And so if the stablecoin market and XRP and Circle and all that are buying treasuries, do you think the government wants to stop that from happening?
Are they actually buying treasuries?
They're buying massive amounts of treasuries. In order to be stable, they're pegged towards the US dollar. Right. Remember, the treasuries are like dollars, but they generate a yield. So if you could be pegging yourself to a dollar, why would you go with the paper money that's debasing all the time? You would do it with the treasuries that's generating an income. But they're pegged to the dollar, so US treasuries. Why would you want to stop that? So yeah, a token like XRP that's tied to that, you can imagine might get a pretty significant boost. I think this boost over here was at the Trump election, where he tweeted out, hey, Cardano, Solana, Ethereum, Bitcoin, whatever, strategic reserve, blast off.
Well, wait, doesn't it say 2024, sorry.
2024, yeah. Rises, and now we're rising again. So does this step change up? Does this do like it did before, where it rises significantly like this, and we get to $15 XRP? Yes. Well, maybe. Who knows? But we're seeing the effects of global dollar liquidity here. And the fact that now we've moved from Bitcoin, which was the thing, right? Bitcoin was the thing that everyone was paying attention to, now into, right? Because Bitcoin's been in a bull market since 2023. Like literally since down over here, Bitcoin is up 600%. But we weren't seeing that in the altcoin market. And now we're starting to see those guys start to wake up. That means we're entering into euphoria phase, baby. Altcoin season. Where rationale, leave it at the door. If you want to make money, smooth brain it. Buy what goes up and keep on buying it.
Not financial advice. You gotta say
not financial advice. Do I have to keep saying that?
Yes. Well, I mean, because if I have to, I need it in every part of the video.
What if in my heart I want it to be financial advice? What do I have to do to make that happen?
Oh, sign line.
Okay, how about not financial advice? Do your own research. We'll just say that. Put it in a loop. Have a button so it loops every 5-10 minutes.
Yeah, actually, that's not a bad idea.
Feels like it's needed.
Trader is excited that alts. I know a lot of people are like snooze. They're like, "It's boring. The market's so boring. Crypto is boring. Why are the alts not moving?" And Tom, you were telling me the whole time. It's coming.
Well, I love that Charles Hoskinson was on the Sean Ryan show.
Mhm.
You can pull that up on the screen. He was on the Sean Ryan show, and to me, I felt like, hey, this is. Haven't I been telling you, Peter? I think that what kicks off the altcoin season is this whole Cardano Midnight token, the whole market plan they have around that, because Cardano's going to be releasing or not Cardano, but Charles Hoskinson on the Cardano network blockchain is going to be releasing a new token called Midnight that allows for privacy within the blockchain space. So they're out there making the rounds. I think it's very exciting, and it's sort of like smart contracts with Ethereum that sparked the run there. And then in Solana, we had the whole pump down fund where it was easy to spin up a meme coin. Well, now imagine we open up this whole layer where we're able to add privacy in a blockchain way to blockchain projects. So what's interesting about that is that if you wanted to build, like, you can build a financial system right now on Solana and Ethereum, because then all your transactions are visible to everybody
Forever.
Who's going to want that? That's not what's happening. So that's why we haven't seen this. Why hasn't crypto completely taken over everything? Well, because you can see all the transactions. Who wants that? But now if you add in privacy, and the Midnight token is set up in such a way that you don't even have to, the end user never even has to interact with the Cardano network directly. It happens with the app developers. It can open up a whole new thing, like smart contracts, but for privacy, but for all the major tokens. Very, very exciting. And what better time for that to happen than altcoin season now? So we're seeing everything wake up. I don't see that stopping until September. And around then, well, we'll talk about what kind of shorts, when to take profits, when to sell off, all that. But before we move on to the market minutes, let's just go ahead and take a word from our overlords.
Ask yourself this. Are you making trading harder than it needs to be? If you're trading manually or still coding just to connect to your broker, yeah, it's time to upgrade. TradersPost lets you automate trades using signals from tools like TradingView or TrendSpider, or even your own custom setup. It works with brokers like TradeStation, Trade8, Coinbase, and a bunch more. I've been using it myself, and getting started was smooth. The platform's clean, setup's quick, and once it's running, it just works. And when you're ready to scale, adding more strategies, plugging into prop firm accounts, or juggling multiple portfolios, TradersPost handles it. It's built to grow with you. Start your free trial at TradersPost.io. Trade smarter, automate your edge.
And we're back. Now, before we leave off, let's go ahead with the market minutes for the last week, because there's all kinds of news that happens, not as interesting as all-time highs in Bitcoin and NASDAQ and all that, but important nonetheless. So Trump imposes a 35% tariff on Canada. Oh, President Trump's 35% tariff on Canadian goods, alongside 15 to 20% global tariff, raises concern about trade disruptions impacting industrial and commodity stocks. Short Canada. U.S.-Vietnam trade agreement reduces tariffs. A U.S. agreement with Vietnam lowered tariffs from 46% to 20%, easing recession fears and supporting market gains. The 30-year Treasury yield hits 5%. Yields on a 30-year Treasury bond reached their highest since 2007, driven by concerns over rising U.S. debt from proposed tax and spending bills. Hey, trillions and trillions of dollars over the next 10 years got to show up somewhere. Although the fact that it's only 5% on the 30-year seems pretty low, but hey. Did you know there's this whole thing that if interest rates hit 6% or more, like that's supposed to spell the downfall of a currency? Have you heard this?
No.
Okay, then don't worry about it. Don't trouble your pretty head.
Well, are we close to that?
We're at 5% on the 30-year. I think it needs to be 6% on the 10-year. I'm not exactly sure about that. Some things I don't know for a fact. Some things I just saw on Twitter. Sort of passed by on Twitter. Gold surges as reserve asset. Gold outperformed as central bank stockpile reserves, surpassing the euro as the second leading reserve asset, boosting gold ETFs. Just a mention here about gold. The fact that gold hasn't cratered, right? If gold doesn't crater, gold stays flat or goes up while we get to all-time highs and the dollar is falling, that means there is mistrust with the global financial system, the solvency of the financial system. Remember, when number go up, people have to chase number go up. Because if you work as a money manager or whatever it is, you work on a prop firm, whatever it is, and you are supposed to be making money to beat the stock market and the stock market is beating you, they hand you your box, you pack it up, and you go drive an Uber or whatever you need to do. Get another job. Because why do they need to pay you if you're not beating the stock market? So high prices, people chase into it because they need to goose up the books, get their numbers to look better, and at least get close to or at the benchmark, because otherwise, why do you need you? However, so the stock markets can be up, equities can be up, while gold still starts climbing up because people go, hey, well, we're up, but the things that are happening economically gives us less faith within the financial system. Trillions and trillions more dollars now are going to be issued or allocated through the federal budget. This does not lend, doesn't make you think highly about the financial system. And so in order to hedge against that, you buy gold. Oh, and the major people who buy gold, do you know who the major people who buy gold are? What really moves the gold price?
Central banks?
Central banks. It's not Nona Papa who are getting Krugerrands inside of their safety deposit box that's making the gold ETFs go up or the gold futures go up. It's freaking central banks. Okay. Crypto stocks rally. Coinbase up 12%, Marathon up 4.9%, MicroStrategy up 2.7%, surge amid broad crypto market strength and stablecoin legislative news. I find it very hard. Well, we know some people who are making money like in the crypto markets and equities. All these strategies of selling calls, selling puts, raking in cash as the market goes up. I'm not participating in that, so I don't know a huge amount about that. But if you're more comfortable using equities as a vehicle for your crypto exposure, there's a lot of options now. Levi stock jumps 6.7%. Levi Strauss & Co. gained 6.7% after strong earnings reflecting consumer sector resilience amid tariff uncertainty. Services sector PMI rebounds. The U.S. services sector PMI rose to 50.8 in June, signaling growth and supporting broader market confidence. I love that 50.8 growth. Yeah. It's about as close to barely any growth as possible. Because so you say there's a chance. NVIDIA leads tech rally. NVIDIA stock rally drove the NASDAQ to new highs, reinforcing tech sector dominance and AI investment themes. Russell 2000 is breaking out. U.S. current account deficit widens, and so on and so forth. Just all the things you would normally expect at the beginning of a euphoria phase in equity markets. It's a great time to be alive if you're a trader and exposed to markets. And if you're not, I don't know what those people think. They must think to themselves, excuse me, what? I'm trying to figure out what bridge I want to sleep under, and you have all-time highs in the stock market. Microsoft laid out 9,000 people, all-time highs for the stock. Company bonuses. So I don't know. It's kind of hard for the regular folks. I get that. But there is a solution to that. Buy stocks, baby. Buy Bitcoin.
Not financial advice. Do your own research.
Not financial advice. Do your own research. There, I said it. All right. That's it, folks. Thank you, Venture Trader. Always happy to see you here. If you guys like what you saw, please like and subscribe. We're giving these news to you guys. We comb the market news so that you don't have to. Anything else you want to say before we leave, Peter?
Very excited about Grok 4. I was just reading, just before coming on here, K2, a new open source model that is close to and sometimes even beats Claude Opus 4. Claude 4 Opus. So we'll see. I'm going to go ahead and play with that. So very excited about those things. We didn't touch on this, and I don't know how this affects the markets, but Mark Zuckerberg
Poaching.
all
Poaching.
people. I think he just $200 million for the COO of Apple. He's
What?
doing yeah, I'm pretty sure. I think I shared it with you.
Wait,
$200
what did you
million.
say? He's offering to poach the CEO of Apple?
No, the COO.
Oh,
I think he did poach them for $200 million. And then
Wow.
the exploding offers he's giving to OpenAI top employees. I don't know if money is going to solve his problem, because Llama 4 did not do well. I don't think I've one word about it was launched. Big, and but I am wondering what's going to happen with OpenAI thing. OpenAI with Johnny Ive's company, that deal has been closed, so they're going to be, I guess, developing a physical product about that. But these companies, right? You can't buy stocks.
Meta, you can. Microsoft, you can.
Meta, you can. Yeah.
Google, you can.
I don't know.
I mean, Meta was at all-time highs just not too long ago. So they're hard not to buy these things. AI, man.
Yeah. So Grok 4, like, I don't know. We're in the hype cycle right now. Could be the best model. It's on par with O3. But I mean, Elon just started this race. You have Usain Bolt, who's like taking 3 Elon's like, hold my beer. Like catching up in no time. March of 2023, his race, and now he's like, worst case, close to tied, and he's going to be releasing a code next month or two. Okay, Elon year, but it's kind of exciting what's going on there. So, stock in Tesla, stock in XAI. I don't know what's going on there, but it seems pretty exciting. Anyway, that's what's on my mind.
There's so much news, so much to trade, so much money to make, and all because of TradersPost. TradersPost is an automated trading platform that allows you to make money in ways you never imagined. Head over to traderspost.io for your subscription and like and subscribe to this channel, because between live trading, developing an automated trading platform, market commentary, blueprint, tutorials, walkthroughs, is there anything we don't do? God, come on, guys, give us a like and subscribe. All right. That's it for us, folks. I will be back next week for more After Hours.